Well, the world views turned a little foggy for the second trading session, and this time a big dip is what we saw on Wall Street. Almost 0.8% for the frontline indices. The NASDAQ declining the most with a cut of almost 1.7%. Why is that? It is the inflation impact. Consumer price inflation at 6.2. It's higher than the expectations of 5.9%, but importantly higher in the last or the highest that we've seen in the last 31 odd years. Highest since 1990, month on month as well. 0.9% is a number which is higher than what the street feared or factored in, or at around 0.6 odd percent. What does this mean in terms of an impact? We did see the US Treasury yields rise, and at the same time, the Fed futures market has indicated higher odds of a rate hike in July 2022. That's had an impact on the US Treasury yields and also the equity markets going ahead. But importantly, we'll watch out for the European markets. They did not do too badly, despite the US markets seeing a bit of a decline, and that's on account of Marks and Spencer's. That one stock led the FTSE move higher. The British retailer saw a 16.5% surge on strong numbers coming in the third quarter. Just watch out for crude. That is something that will hearten the Indians, because from $85 yesterday, it's now fallen to $83, and that's on account of increasing US inventories. The Asian markets are taking note of what took place on Wall Street, and most of them are lower, and as is the SGX Nifty, which indicates a softer start to the weekly options expiry.
All right, Mangalam, thanks very much for that. Arvind Sanger is managing partner at Geosphere Capital Management. He's joining us right now for a quick chat. I think we have to begin. Arvind, thanks for joining in with the inflation print in the US and how the market took it, especially the tech sector. What are your thoughts, Arvind? I mean, I saw some, this is some time back, and I mentioned this earlier, that historically, last 30, 40 years, equities in the US start to struggle when inflation gets to the average 4% level. We're at about 3.6 right now. Not an exact science, but I mean, could be sort of useful in thinking about, I mean, when does inflation really start to pinch from an equity perspective? Your thoughts?
Well, I think that the reason that inflation matters so much right now is because the Fed has been super dovish till now. So this suggests that the Fed is going to have to remove its accommodative policy. And the removal of that accommodative policy means that the pace of both, normalization of their buying is going to go away, the tapering, sort of, as it's called, and the interest rate cycle is probably going to start moving up faster, maybe by middle of next year rather than 2023, as the Fed had been suggesting. So I think that the biggest headwind for the markets is not the fact that inflation is, inflation in a normal cyclical recovery going up a little bit is normal, but this is much more than normal. The headline inflation on an annualized basis, this increase was more like 6%. And that's a big deal. So therefore, inflation is proving to be stickier. And that's been our concern, that inflation will prove to be stickier. And we think, from an Indian market standpoint, the question arises, is this only a US phenomena? Or is this something that is, and it's not just a US phenomena, we've seen in many countries, is India immune to it? And if it's not, can the RBI afford to be as laid back as it has been so far about inflation fear? So, I think all central bankers are going to face this question. How are you going to fight inflation? Are you going to keep inflation under control or not?
I think, Arvind, good morning. Inflation has already hit our own markets and earnings, right? We've seen it across the board, across industries. But how are you approaching India now? Do you think that at worst we could get into a consolidation phase where there could be a bit of a time correction? Or are you foreseeing some price correction as well as we head into the end of the year?
I think I'm concerned about both time and size correction. Look, there's a lot of, big IPOs that are sopping up liquidity in the market. And if we do get an inflation scare, I think that is going to cause a little bit of a risk-off globally. And India is certainly no exception, even if the growth outlook, medium term looks reasonably good. I think the reality is there's a lot of hot money that is, a lot of retail investors that have discovered online trading, that have been, whipping money around. And I think some of that easy money, as it comes out, could cause some correction. Is it the end of the cycle? Is it something that investors should hunker down for? No, but we've taken some exposure down, and we're waiting for a pullback to get better buying opportunities, because we do believe that this inflation scare will prove to be more than one day or 1 week wonder, and if it lasts for a while, then there could be some downward pressure on equities.
Okay, so lots of caution. Arvind, good evening to you. You mentioned lots of big IPOs, so that's my question. I'm not asking you about Nykaa. This question is more directed towards Paytm, and I don't know if you had a chance to see Zomato's performance overnight. What's the chatter out there on some of these companies? It's all about directing the attention towards the top line and the much longer term growth, and ignoring sort of the lack of sustained profitability right here, right now. Is that something that investors are willing to digest?
Well, I think they're following the playbook of what's worked, in global markets. Certainly, U.S. markets have been, prime example that over time, some of these market-leading companies in a number of emerging technology sectors have delivered significant returns to investors. So people are hoping for and assuming the same thing in this case. Amazon had no bottom line and only top line 2 decades ago, and there were a lot of people who predicted its demise, and today it's the largest company in the world. So I think there's a model for that, but the reality is not every company turns out to be an Amazon, not every company turns out to be a Tesla, but the hope is that from these unprofitable beginnings, but in market leadership companies, many of these will turn out to be real businesses with real earnings and real profits and real long-term growth. And I think the market may prove to be correct over the long term, but nothing has ever, including some of the big winners in the West, gone straight up from their IPOs. There were, big sell-offs along the way. So I would be very cautious about piling into a whole lot of these, these really hot names. And I'm not picking any particular name, but Zomato, Nykaa, Paytm, there's many others that have come public or are coming public. And the reality is that it will be a volatile ride along the way to profitability. And many of these companies may prove to be winners long-term. Some may not. But there will be real gut-checking moments and gut-testing moments along the way. And I think there's a lot of hot money in some of these names, which may not be able to ride out the volatility.
So, Arvind, just a follow-up question to that, and we're seeing this in some way in Paytm. They're getting into related businesses. They want to sell mutual funds. They want to sell insurance. They already have that platform. And we're seeing that now with Zomato, where they want to invest in a lot of different things. They're investing into fitness. They're investing into sort of a gym setup, in Magic Pin. As an investor, how do you see this utilization of cash? Do you see that, okay, it's a good thing, they're getting into newer age, fancy businesses? Or does it worry you because the core business itself is not stabilized?
Yeah, I think that, when you have these, tech recent unicorns that have now grown into, mega unicorns and are now, multi-billion, multi-tens of billions dollars market cap companies, I think the risk is that money is going to burn a hole in their pocket and they're going to lose a little focus. So my preference is companies that, are adjacent to what their core competency is. So, if Policy Bazaar is an insurance and they sell financial products along with insurance, that's a reasonably logical sequence. But Paytm is in one aspect of payments, and maybe some related fintech businesses would make sense. But some of the businesses that are being talked about are a little bit far afield, and therefore there is no one size fits all. But it really is the kind of analysis that we do anywhere else. Does it make sense, or is it money being thrown around just hoping that one platform in one sector will lead to multiple winners in multiple unrelated areas where there may not be as much synergies? And that's one of the questions that will depend on each company to try to analyze that.
Okay, Arvind, it was a great chat this morning. Thanks a lot for joining us. Have a great day, and hope to speak to you again very soon. So there are definitely pressure points that this market is facing. Inflation is one of them, and the slew of IPOs that are hitting the market is sucking out the liquidity. So perhaps there could be some downward movement. That's the word coming in from Geosphere. Let's take a quick break. On the other side of the break, our entire team will be with us to help us prep for the day. Our top 10 stocks lined up in just a bit. Stay tuned.